Last summer, spot Ethereum ETFs launched to a collective yawn. No staking yields, higher fees than holding actual ETH, and no real selling point versus the spot Bitcoin ETFs. The result was next to no inflows. But since this summer, spot Ethereum ETFs have been pulling in billions, all while liquidity has been spilling out of their spot Bitcoin rivals. Notably, August was the first time that the flows of spot Bitcoin and spot Ethereum ETFs moved in completely different directions. So, what's going on here? And why is this rotation happening? And could we see capital rotate into other altcoin ETFs as they're listed? Today, we'll find out these answers to all of these questions and more. My name is Lewis. Stay tuned. US spot Bitcoin ETFs now hold between $150 and $160 billion of Bitcoin. We're talking 6 to 7% of all BTC that exists, locked up in products that your retirement advisors can now legally recommend. To put things into perspective, $54 billion of fresh capital has flowed into the spot Bitcoin ETFs alone. So, mission accomplished. The institutional money is really rolling into crypto now, right? Well, maybe. The ETF infrastructure functions exactly as advertised, but the buyers are not exactly the cohort that the crypto media has been claiming. Bitcoin financial services firm NYDIG found retail investors accounted for 81% of spot Bitcoin ETF ownership in Q1 2024. As of Q2 2025, retail investors still held around 74 to 77% of Bitcoin ETF shares, according to CoinShares. We're talking 100 to 110 billion in retail hands through Robinhood and traditional brokers. Hedge funds, pension funds, and endowments control the remaining 23 to 26%. In other words, your neighbor who discovered crypto during lockdown still holds more Bitcoin ETF shares than most professional money managers. The institutional share is creeping up from 19% to 25% over 18 months. But at this pace, it'll be 2030 before institutions control even a third of spot Bitcoin ETF flows. Not only that, but the institutions that have been buying have been doing so using their pocket change. For example, Abu Dhabi's Mubadala has $681 million in Bitcoin ETFs. Impressive, until you realize that's 0.2% of their $300 billion portfolio. Meanwhile, Wisconsin's pension fund, which was applauded for aping in, has already panic sold. At the same time, Michigan's pension fund is holding $11 million in Bitcoin ETF shares like they're handling live grenades, with extreme caution and a finger on the trigger. Put simply, most institutions are sprinkling their dry powder into spot Bitcoin ETFs rather than shoveling it in, which is part of why retail flows have dominated so far. The retail-heavy ownership structure showed its true nature in August. Not long after BTC broke a new all-time high above $124,000, spot Bitcoin ETFs experienced net monthly outflows of $751 million. When you consider that the spot Ethereum ETFs absorbed $3.9 billion that same month, this suggests that some of the net outflows from the spot Bitcoin ETFs found their way into the spot Ethereum ETFs. Further evidence for this can be seen on-chain, where Bitcoin whales have been selling BTC to accumulate more Ethereum. But this begs the question of why we're starting to see a rotation from Bitcoin to ETH, particularly in the ETFs. To find the answer, we have to look at the history of the spot Ethereum ETFs. July 2024's Ethereum ETF launch was underwhelming by any measure. Day one, $484 million fled Grayscale's converted trust as investors escaped its 2.5% management fees. Net flows ended basically flat. While Bitcoin ETFs had captured billions on launch day, Ethereum barely registered a pulse. Everyone paying attention knew why. Native Ethereum yields 3 to 5% annually through staking. ETF holders get exactly zero. It's like buying a rental property but being unable to collect any rent. And for 13 months, that logic held. Ethereum ETFs limped along capturing modest inflows, but nothing spectacular. Then in August of 2025, 3.9 billion poured in during a single month, while Bitcoin ETFs lost 751 million. Of course, the timing was no coincidence. BlackRock had just filed with Nasdaq to enable staking for its ETH-A ETF. If approved, their spot Ethereum ETF transforms from a 0% yield product to a 3 to 5% yield machine overnight. The infrastructure is already there. Coinbase Custody runs institutional validators and provides slashing protection. Now, something to note here is that an $11 trillion asset manager doesn't file regulatory paperwork for fun. Now, do the math on staking yields. 29 billion in Ethereum ETF assets generating 3 to 5% annually equals $870 million to $1.45 billion in staking rewards. Even taking a modest 50 basis point management fee on those yields generates serious revenue. Every major issuer sees these numbers. The race to enable staking is on. Portfolio algorithms saw this setup immediately. Bitcoin at all-time highs, Ethereum staking on the horizon, volatility compression signaling rotation. When quant models managing hundreds of billions spot that pattern, they don't hesitate. And the ETF structure made it frictionless. Sell IBIT at 10:15 a.m., buy ETH-A at 10:16 a.m., rebalancing completely. And by the way, if you're thinking of doing a little rebalancing yourself in and out of cryptos, then you have to check out the Coin Bureau's deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get the goodies, all you need to do is just hit the link in the description or scan the QR code on the screen right now. Then once you get on the deals page, just find a deal that suits you and click one of the sign up now buttons. Now remember, these deals, they won't be around forever, so you should take advantage of them while you can using the link in the description or the QR code on the screen. Now, talking about the ETFs, not all of the $3.9 billion that flowed into the spot Ethereum ETFs was pure bullishness. Around 20% of August's Ethereum ETF inflows came from cash and carry arbitrage, traders buying spot ETF shares while simultaneously shorting the futures market to capture the premium. When ETH futures trade at 6 to 7% annualized premiums, institutions could lock in risk-free profits by going long the ETF and short the future. It's not speculation, it's just math. This arbitrage activity actually stabilized ETH's price during the rotation from Bitcoin rather than pushing it up. Every $1 billion entering through arbitrage creates less price pressure than directional buying because it's hedged. Put differently, the sophisticated players weren't betting on ETH mooning, they were harvesting yield from market structure inefficiencies. You know how it goes. Find the free money first, then believe in the technology later. Still though, BlackRock's ETH-A crossed $1 billion in assets at breakneck speed. Ethereum's Denkun upgrade had already slashed transaction costs by 90%, and suddenly you could actually use Ethereum without spending your kid's college fund on gas. Lower fees, potential staking yields, and algorithms trained to rotate at peaks all pointed the same direction, out of Bitcoin and into Ethereum. Now, for reference, much of the August rotation from Bitcoin to ETH happened in a very short space of time. On August 21st, analysts identified a single whale or small cluster of whale addresses responsible for as much as $2.6 billion in rotations from Bitcoin to Ethereum. And for good measure, they also immediately opened up long put positions on ETH after rotating. By month's end, they controlled over $4 billion in ETH, surpassing most corporate treasuries. When someone moves that much capital, it's not subtle. Every algorithm on Wall Street notices. Prime brokers see the flows, risk models recalibrate, and trading desks adjust their books. Within 48 hours, what started as one whale's repositioning cascaded into market-wide rotation. Bitcoin ETF redemptions accelerated while Ethereum ETF creation units couldn't keep pace with demand. Authorized participants, or APs, make the entire system function. JP Morgan, Jane Street, and other large players create and redeem ETF shares by delivering or receiving the underlying crypto. When Ethereum ETF demand exceeds supply, APs deliver ETH to the fund and receive new shares to sell at a premium. Bitcoin showed the opposite dynamic. Excess share supply meant APs bought discounted shares and redeemed them for Bitcoin. Classic arbitrage keeping prices aligned. This arbitrage mechanism helped prevent what should have been devastating price swings. $1 billion leaving Bitcoin typically triggers 5 to 10% corrections. $4 billion entering ETH should create parabolic moves. Instead, Bitcoin maintained its trading range while ETH rallied to an all-time high of $4,953.73 on August 24th before retracing modestly. Here, we saw ETF infrastructure absorbing flow shocks that would have wrecked spot markets in 2023. Now, despite Bitcoin's billion-dollar bleed, total crypto ETF assets actually grew in August as money reallocated between them. We're watching sector rotation like you'd seen between technology stocks and energy stocks, except it's happening between cryptocurrencies. And that's how mature markets behave. For 18 months post-launch, Bitcoin and Ethereum ETF flows moved in perfect correlation. Money entered both or left both. Now they're showing an emerging inverse correlation trend. Bitcoin outflows on Monday increasingly predict Ethereum inflows by Wednesday. The rebalancing algorithms have learned to treat them as distinct assets rather than a monolithic crypto allocation. Something to keep an eye out for the coming weeks. Another thing to watch in the coming months is how the spot crypto ETFs get adopted by TradFi, and not just in terms of flows. Earlier this year, JP Morgan announced that they'd accept Bitcoin ETF shares as loan collateral. Not Bitcoin itself, mind you, but IBIT shares are now acceptable collateral at America's largest bank, right alongside Apple stock. They assigned it 100% risk weighting, meaning there must be dollar-for-dollar capital against Bitcoin ETF collateral versus 20 to 50% for traditional securities. Even in acceptance, they're treating it like radioactive material. But the precedent matters more than the percentages. Bitcoin ETFs are now officially part of the traditional banking system's collateral framework. Rich clients can now borrow against Bitcoin positions without selling, triggering taxable events, or explaining to their wealth managers why they need to wire money to something called Kraken. Family offices get liquidity without liquidation. The integration is seamless because to the banking system, IBIT looks identical to SPY, just another ticker to process through existing infrastructure. Q2 2025 marked a watershed for other institutional adoption metrics. Bitcoin ETF holdings grew 57% quarter over quarter from new allocations alone, while Ethereum ETF holdings doubled. Harvard parked $117 million in Bitcoin ETFs, making it their fifth largest holding. The thing is, though, even though that does sound massive, you have to realize that it's only 0.2% of their $53 billion endowment. Still, the same endowments that wouldn't return crypto fund managers' calls 2 years ago now hold positions, even if they're just minuscule ones. Still, we need perspective. Crypto remains under 1% of institutional portfolios on average. A typical $10 billion endowment might hold $50 to $100 million in crypto ETFs. That's meaningful progress from zero, but hardly the institutional stampede bulls predicted. The infrastructure exists and works perfectly, but institutions are walking through the door, not running. But what about all those other altcoin ETFs that you've been hearing about? If you haven't been paying attention, over 90 crypto ETF applications currently sit with the SEC. 7 different firms want Solana ETFs, 5 applications for XRP. Even Dogecoin has multiple filings gathering dust in regulatory purgatory. Well, the floodgates started opening in July. Rex Osprey's Solana staking ETF launched on July 2nd, becoming America's first crypto ETF that actually pays staking yields. It pulled $12 million on day one, passing through 100% of that 7.3% yield via dividends. SSK bypassed the traditional 19B4 filing process entirely, using a 40 Act structure to sidestep the regulatory bottleneck. While everyone else waited in line, Rex Osprey found a side door. And through Bitcoin and Ethereum approvals, we can infer what the SEC wants: roughly $10 billion minimum market cap, $1 billion daily trading volume, sufficient decentralization metrics, qualified custody providers with insurance, and surveillance sharing agreements with major exchanges. Bitcoin and Ethereum cleared these hurdles without a problem. Most altcoins, though, they faceplant at the starting line. Solana presents the most compelling case post-ETF launch. Market cap clears the threshold easily at over $100 billion. Volume usually hits the billion-dollar mark, but 66% of stake controlled by a relatively small validator set makes it look centralized compared to Bitcoin's distribution. The staked Solana ETF got through using a different regulatory pathway. Traditional spot ETF approval faces higher bars. Bitcoin trades $60 billion daily across global markets. Solana manages $2 to $3 billion on good days. Many other altcoins celebrate when they crack 500 million. Thin liquidity means wider spreads, easier manipulation, and more expensive ETF operations. You can't manufacture market depth overnight. Even so, Bloomberg analyst Eric Balchunas and James Seyfarth put 95% approval odds on XRP and Litecoin ETFs by year-end 2025. These aren't random guesses, though. They're based on regulatory tea leaves and the SEC shift towards more objective criteria. The SEC's got a streamlined 75-day review for some filings, but they still control every approval. August's rotation proves appetite exists for crypto diversification. If billions can rotate between the top two through ETF wrappers in a single month, the infrastructure clearly works. More importantly, the staked Solana ETFs demonstrated staking ETFs are viable. Each precedent makes the next approval easier. XRP and Litecoin could get ETFs approved by year-end 2025 if Bloomberg's odds hold. For the broader altcoin wave, though, that's 2026 territory. The SEC likely wants to see how the staked spot Solana ETF performs and whether Ethereum staking ETFs work. 8 months separated Bitcoin and Ethereum ETF approvals. Expect similar gaps between future ETFs. Now, before you pencil in a new alt season on your calendar for sometime in 2026, let's remember that ETF flows don't control everything. Academic studies converge on consistent findings. ETF flows explain 10 to 30% of Bitcoin's daily price variance. The other 70 to 90%, well, those are macro headlines, regulatory developments, Fed decisions, and Trump and Elon Musk tweets. Probably. ETFs matter as one factor among many. It's not the puppet master pulling all the strings, as many have been led to believe. What's fascinating, though, is that research by prime brokerage Falcon X found that ETF flows impact price within a 3 to 4 day delay on average. Pour $1 billion into Bitcoin ETFs Monday morning and you'll see it reflected in Thursday's price. The correlation works out to approximately 1 to 2% price appreciation per $1 billion in inflows. But with Bitcoin's average daily volatility at 4%, that signal drowns in normal market noise. January to February 2024 was the outlier period, and it was temporary. During the launch frenzy, ETF flows explained up to 95% of Bitcoin's price movements, according to analysts by Coinmetrics and Falcon X. Unprecedented institutional access, meaning finite supply, created temporary flow dominance. Once the institutional sugar rush subsided, though, and flows normalized, traditional market dynamics reasserted themselves. August 2025 provided the perfect natural experiment. Bitcoin ETFs hemorrhaged $750 million without triggering a crash, as BTC's price held firm in its range. Ethereum ETFs absorbed $3.9 billion and ETH reached an all-time high, $4,950 on August 24th before settling back. Sophisticated market makers absorbed these flows through arbitrage mechanisms before they could impact spot markets dramatically. The plumbing worked exactly as designed. So, TradFi has the perfect crypto rotation machine. Billions can now slosh between Bitcoin and Ethereum like money market funds chasing 10 basis points. JP Morgan will even let you borrow against it, though they'll treat your IBIT shares like plutonium. The machinery works perfectly. It just doesn't control what you think it does. ETF flows drive maybe 30% of price action, while the rest remains pure crypto chaos, macro panic, regulatory roulette, and whatever Trump posts at 3 a.m. 90 altcoin ETF applications are gathering dust at the SEC right now. Most will probably die in the waiting room. But the survivors are about to discover what happens when Wall Street's rebalancing algorithms meet tokens with the liquidity depth of a puddle. And if you want to know which ones actually stand a chance, and why Solana's backdoor staking ETF might have just broken the whole game open, you can find that out right over here. That's going to be all from me for today. Thank you so much for watching, and I will see you again soon. It's Lewis, signing off.